I'm bearing bad news. Not good. Ah, man, let's just get into it. I can't even tell you what's going on, guys. Unfortunately, rates are moving up. Yes, I know this is green, but it's not, it's just for the moment. The reality is rates are in the sevens. They've been in the high six, low sevens, according to mortgagenewsdaily.com. Obviously, people can pay money to get those down. So if you see rates saying like 6 point something, just realize there's money attached to that. But here's why. Well, first, forget the why. Let's just look at it. Look at this big old beat down on the men. Remember, red is bad, guys. Red is higher rates. So we got a big old stick right here on the far right, just showing that the CPI inflation reports came out and they're hotter than expected. And you can see last Friday, that little L and then the little lock next to it where it got red and we went below all those squiggly lines. That's the job reports because job reports came out saying that things were better than expected. Employment rate still low. While that's good for the economy, that's bad for inflation. And if it's bad for inflation, it's bad for mortgage rates because that means the Fed will most likely not be as aggressive for cutting rates. So, guys, here's what happened. The CPI came out on Wednesday, and the headline CPI, which means like kind of just, everything, jumped from, it went up. Basically, it's from 3.2 to 3.5. So it jumped 0.3, 0.4, whatever you want to call it, but the core is still at 3.8. So core is when they strip out the food and energy. But the reality is, no matter how you look at it, it's still not good. And so here's why. Look on the right side column. Shelter alone is 45% of this number. And the problem is, like we said, so if you've been watching since last year we said this was coming down. That's why inflation would come down when it was super high, and it did. The problem is, guys, shelter, it's 45%, and it's the reason why the inflation went up 0.2% just this month, or the month over month change. The problem is the numbers that it's going to be replacing in the foreseeable months, they're not going to help us. So I just don't know that inflation is going to come down that fast where the Fed can justify cutting rates. You can see the motor vehicle insurance, that alone was 0.1% increase in the number. So of the 3.5 and 3.8%, you're looking at 0.3 of it just coming from shelter and motor vehicle insurance. So those two things alone are super hard to change because, again, cars aren't getting cheaper to build. They're more fancy, more computers, all this stuff's going on. A lot of theft, I guess, is also part of that because they are so expensive. People are stealing them. So I don't see motor vehicle insurance coming down. And again, for the shelter for the foreseeable future, I don't see that coming down either. So we got a long way to go before the Fed can start cutting rates. So along that lines, we've always said about a third. That's usually my number. If you ask me like how much of the market is paying cash, it's about, call it 33%. You guys can see how it's been even more so in the last year or so, just as rates have gone up. Money supply. This was fascinating. So M2, there's money supply. So M1 is like what's out there in terms of just, liquid money, what's going on. M2 it takes into consideration other things that aren't quite so liquid, like CDs and money markets and things like that. But basically, the money supply has dropped. You can see how much it's increased since 1960. And money supply, as far as what people have, and it spiked there during COVID when people couldn't go spend their money, they couldn't do anything, and they were getting government subsidies as well. Now it's dropped. And when it drops this much, it was over, I think anytime it drops over 2% from the article I read, anytime it drops over 2%, recession hits. And it doesn't just hit, it hits pretty hard. And I think we've gone, if I'm not mistaken, from about over 4% drop, which doesn't seem like much, but it is when you consider that history says that there's a US recession coming in play because of this. So we'll see. I've talked to some financial experts. They think if it happens, it may be, a 6 to 12-month recession, but time will tell. These are some markets. So we did one last week about the number of $1 million cities out there. We are now at a new high. Again, California has the most with 210 cities, where a typical normal house is $1 million, which is pretty wild. The chart on the right I thought was interesting, guys. Dallas, or I should say Texas. Texas is in the mix because of how much land we have to build. California, apparently not a lot of buildings going on, but you guys can see how the three bigger markets, California, Florida, Texas, as far as homes on the market, just from July 16 to now, we're getting more and more homes in Florida. Good for them. Texas, we're trying. The builders are doing their best, but you guys can see how more and more houses are coming online. But a part of that is to help this millennial era, which is now apparently the largest group of homebuyers. They've taken over. Good for them. So the Gen Xers, that's me. We're 20, 23, 24% of buyers and sellers. But you see the young, they call them old millennials and young millennials. you can see those two combined. The millennials are now beating the boomers. So congratulations, millennials. But look at the Gen Zers. Good for them. Coming out of the woodwork here. That's the 18 to 24 years old. So in all seriousness, I like to make fun of the Gen Zers, but in all seriousness, 18 and 24-year-olds are buying homes. So that's a really young age. Good for them. And keep it up, Gen Zers. We need you. Purchase loan credit, their credit scores are the highest in a number of years, which is crazy. So you guys can see the blue line, that's the purchases. You can see that credit scores are really good. So according to this, it's saying that the credit scores for rate and term refinances and purchase business, you're looking in the 730 and above, which is pretty wild when you consider, we don't see that a ton. But the cash out, you can see why cash outs, if you don't know this, when you try to take money out of your home, you do pay a higher interest rate on your mortgage, on your rate, because the cash out is seen as a sign of distress. That's not always true, but the reality is, because that's these stats are what makes your interest rates higher when people want to take cash out of a home. So there you go. I thought that was really interesting. The other reason why we have an inventory shortage, guys, is people are becoming, as this article calls it, accidental landlords, meaning obviously if you got a 3.x rate, you may not want to sell your home. You keep it because maybe you cash flow. I got to be honest, I have a personal opinion on that, not necessarily professional, but I have a personal that I think selling, getting your equity and using that for other things in life may not always, may be better, but good for these folks that are holding on to their homes and their lower rates, but that doesn't help us from a housing supply where buyers are out there because there's still a housing shortage. That's one reason, is because these people are keeping these houses too long. I don't know what to make of this, but I'm going to share it just because supposedly these are markets. So Dallas, Fort Worth is on the, it's the chart on the right. The expected, I don't know who's expecting these prices, but supposedly these expected prices and what people are paying, according to this article, the Dallas Fort Worth is paying a 23% premium on their homes. In Atlanta, Georgia, people are paying 41% over ask. I got to be honest, guys, I'm not sure and how and why what this expected comes from, but the reality is what somebody's willing to pay for the house, especially if there's multiple people willing to pay for it, to me, says that should be the expected price. But I just thought I'd share this because people are like, oh, the market's overinflated. And look, it is, but there's still a shortage. There's too many people trying to buy too few homes. So supply and demand kicks in, but I just, again, trying to show both sides. There you go. Look, Dave and I don't always agree, but for those that are Dave Ramsey fans, he's been saying the same thing. There is a housing shortage. There is no chance for the bubble in the near future. I agree that we have just not enough homes out there. So just throwing it out there that says, I'm not alone. I'm not making this up. Let's have some fun, baby. College is going to cost $100,000 a year, which is wild. So Vanderbilt students just got $100,000 in total expenses for the school year. That does include room, boarding, and all that other stuff, but that is wild to me, $100,000. So along those lines, you have until April 30th. If you are somebody that has student loans, you may be eligible for the Biden administration's temporary offering of combining loans and doing all that fun stuff. So if you're out there and you haven't done it yet, you probably should. If not, hey, is what it is. So guys, I've always advocated, my girls have Greenlight. Greenlight's they got their own banking account. My girls have their own investing. They give to charity. They do all this stuff. Well, now this article makes me think a little different, and I'm still going to do it because I think kids need to be educated on money. But the reality is apparently the kids are getting more stressed out, as young as 14 years old about money. So I think be careful of what you say, be careful what you do. You need to educate them. But here's the other stat that I just thought was fascinating. If you're, it's kind of like sex education, guys. If you're not having the conversation with your kids about sex education, somebody else will. So control that messaging. I think the same thing goes for money. So when it comes to where the kids are getting their financial information, over half of them are getting them on social media. So I don't want some 21-year-old, no disrespect to the 21-year-olds out there. I don't need a 21-year-old telling my kids about money. I would like to have that. I'd like to control that messaging. So this is my public service announcement for the day. Take control of your kids' future and help them learn about money so that they don't fear it and they know what they're doing with it. And then this one I saw because we went to it in New York. Insomnia Cookies. My kids loved it. Apparently this dude, good for him, just was a college student, had a late night craving. Whether or not there was a reason for that late night craving to be determined. But he's done over $200 million a year in business selling cookies. So good for him. In the meantime, I'm schlepping mortgages, happy to do it, love to do it, but that's just a lot of cookies to sell. That's incredible. Good for him. And then lastly, for the continuing or for chasing excellence, guys, this week, my coach maybe formalize and turn in our purpose, our mission, our legacy, all that's, fuzzy feel good stuff. But the reality is it was a fantastic exercise. I spent way more time than I'm going to admit to you here doing this. But if you don't know your purpose, I didn't know mine. I wasn't able to articulate it pretty quick, but basically mine's to inspire and empower growth, right? We do that for our home buyers to hopefully help them and empower them to understand what a mortgage can do and how to integrate with their financial plan. I do that with my employees, trying to make sure they're inspired and empowered to grow, whether it's financially or as people. And same thing with my kids and all that. That is my purpose. Again, it may be different from yours. If you want to take it, more power to you. But it was a really fun exercise. I've done it many times in the past. I don't know why, but somehow this one just finally connected. So if you haven't done it, do it. And if you need help on it, ping me, because I have tips on what this version or iteration did this time. And then lastly, guys, for the fun, the mortgage mark meme of the week: when you waited to buy and now you're paying $50K over the listing price. Funny stuff. Goes back to that what we just shared earlier. So guys, as always, let's get social, baby. Come on, share this, forward it to somebody you know, somebody that might get some value out of this. Feel free to copy any and all of it and use it for your own marketing. And as always, just appreciate you. Have a wonderful rest of the week, and we'll see you next week.